So imagine you're in the fourth quarter of 2025, and the United States government basically just, turns off the dashboard for the entire American economy.
Just unplugs it entirely.
Right, unplugs it. There's a federal government shutdown, and it severely interrupts the release of all the major economic indicators.
Yeah, which is terrifying if you think about it.
Oh, absolutely. I mean, we're talking no official inflation data, no reliable employment numbers, and just a total absolute blackout on GDP updates.
Right.
And if you're an institutional investor, managing billions of dollars, it's the financial equivalent of flying a massive cargo ship right through a Category 5 economic storm. But all your navigational instruments have just suddenly gone completely dark.
You're just flying totally blind.
Exactly. And yet, right in the middle of this total data blackout, Two Harbors Investment Corp, they trade under the ticker TWO. They make this decision to fundamentally alter the structure of their whole company.
Yeah, a massive shift.
Right. They announced this merger that doubles their mortgage servicing portfolio to just staggering $400 billion.
Which is an incredibly difficult number to even conceptualize.
Yeah, it really is. So for today's deep dive, we are unpacking the Q4 2025 earnings call transcript from Two Harbors. The goal here is to really understand the pure financial engineering required to, fly blind at that kind of speed.
Right. And the scale of that $400 billion figure, it really doesn't make sense until you break down the actual mechanics of what Two Harbors is acquiring here.
Yeah, lay that out for us.
So they're stepping into this market environment that is heavily distorted by unilateral policy levers, and they're doing it by partnering with United Wholesale Mortgage, or UWM.
Right, UWM.
Yeah, and UWM is the #1 mortgage originator in the whole country. So to understand why a specialized asset manager like Two Harbors is locking arms with a massive origination factory like UWM, you really have to look at Two Harbors' historical pedigree.
Yeah, because they didn't just stumble into this asset class yesterday, right?
Yeah, exactly. No, back in 2013, they were arguably the very first mortgage real estate investment trust, a REIT, to allocate capital specifically into mortgage servicing rights.
Okay, let's actually strip down the jargon for a second there, because understanding the mortgage servicing right, the MSR, is really the key to unlocking this entire earnings transcript.
Yeah, you can't understand the company without understanding the MSR.
Right. So an MSR is not the mortgage itself. Like if you are a homeowner, you borrow, say, $400,000 from a bank to buy a house.
Yep.
The bank might then go and sell that actual debt to Fannie Mae or Freddie Mac. But someone still has to collect your monthly check, calculate the escrow for your property taxes, pay your homeowner's insurance, send you statements, all of that.
All the annoying administrative stuff.
Exactly. The administrative function. That right there is the servicing right.
Mm-hmm.
And the entity performing that function takes a tiny slice of the interest rate, usually around, 25 basis points, so 0.25% as a fee.
Right.
And Two Harbors realized over a decade ago that buying these administrative rights in bulk, it creates this massive, highly predictable cash flow engine.
They did. But it's important to note that the operational realities of managing those rights, they've evolved dramatically since 2013.
How so?
Well, initially, Two Harbors functioned purely as a financial aggregator, right? They just purchase the MSRs and farm out all the actual heavy lifting.
Oh, like the call centers and tax payment processing?
Exactly. They outsourced it to third-party subservicers. But relying on third parties, it eventually eats into your profit margin.
Right, because everyone needs their cut.
Yeah. So they eventually acquired a company called RoundPoint, which essentially brought all that administrative machinery completely in-house. They basically bought their own engine.
Okay, so they own the machinery now. What's the problem?
The problem they face in 2025, and CEO Bill Greenberg really outlined this on the call, is that the margins across the entire mortgage industry have just compressed. The cost to service alone is going up, the regulatory burden is a lot heavier, and in order to justify the fixed costs of maintaining a best-in-class platform like RoundPoint, you need overwhelming volume.
Like massive scale.
Yeah, scale is no longer just a competitive advantage for them. It is an absolute prerequisite for survival.
Which perfectly brings us back to UWM, because UWM is an origination machine.
Yeah.
I mean, they work through this massive network of independent mortgage brokers to underwrite and fund new loans.
Right.
But if you look at their business model, historically, UWM hasn't really wanted to hold on to the servicing rights long term.
No, not at all, because servicing is incredibly capital intensive.
It requires massive liquidity reserves, right?
Exactly, and it ties up cash that UWM would much rather just use to originate even more loans. So UWM desperately needs a reliable, massive buyer to take these MSRs off their hands the exact moment the loan is closed.
Okay, so that is the core synergy of this merger. UWM represents this unparalleled pipeline of newly minted MSRs, and Two Harbors represents just a bottomless sink for those assets. Yeah. Backed by all this deep capital markets expertise.
Yeah, because when you hold billions of dollars in MSRs, you aren't just sitting back cashing checks. You have to actively hedge the value of those rights against interest rate movements.
Yeah, you have to finance them efficiently on Wall Street.
Exactly. So UWM gets to offload the capital burden of holding the MSRs, and they also get to leverage Two Harbors' in-house Round Point platform, which is this highly efficient, low-cost servicing chassis.
So it's like the perfect marriage of a world-class manufacturing plant with a world-class logistics and storage network.
That's a perfect way to put it, yeah.
Okay, I see the synergy on the MSR side, absolutely.
Yeah.
But I have to look at this from the perspective of an existing Two Harbors shareholder.
Sure.
If Two Harbors is transforming into this massive MSR vehicle tethered to UWM, what happens to the other side of their business?
The securities portfolio.
Right. Because traditionally, Two Harbors holds a massive portfolio of standard RMBS residential mortgage-backed securities. The actual bonds backed by the mortgage debt.
Yep.
So does this merger signal a slow liquidation of the securities portfolio? Like, are they exiting the bond trading business to just become a pure play servicer?
Yeah, so the management team completely anticipated that exact anxiety from investors. And Greenberg was incredibly measured in his response to that.
What does he say?
He stated unequivocally that for the immediate future, it is entirely business as usual regarding their securities portfolio. There's no fire sale happening.
Okay.
They aren't liquidating their RMBS just to fund this UWM integration.
Right, but the long-term mechanics have to change, don't they? I mean, you don't double your MSR portfolio to $400 billion without fundamentally altering your balance sheet risk.
Oh, you don't. And management fully acknowledged that reality.
Yeah.
They noted that over a longer horizon, yeah, there are potential paths where they might strategically sell down certain RMBS assets.
Makes sense.
But they also introduced a really fascinating counter scenario. To properly hedge a $400 billion MSR portfolio, the newly combined company might actually require a larger footprint in the securities market.
Wait, really? A larger footprint?
Yeah. Specifically, they pointed out they might need to dramatically increase their positions in TBA contracts.
Oh, okay. Let's break down the TBA trade for a second, because it's a really crucial mechanism for how these REITs protect themselves.
Yeah, it's essential.
TBA stands for to be announced. It's basically a forward contract.
Right.
So if Two Harbors knows they have a massive wave of MSRs coming out of their books from UWM, they can enter into a TBA trade where they agree to buy or sell mortgage-backed securities at a future date, at a set price, without even knowing the specific underlying loans yet.
Exactly. It is the most liquid way for them to quickly adjust their overall exposure to interest rate risk.
So if they are absorbing UWM's massive origination volume, their need for that liquid hedging capacity is going to have to scale up proportionally.
Yeah, the TBA market basically allows them to synthetically short or go long the entire mortgage market in massive multi-billion-dollar clips within seconds.
Wow.
So if UWM is just pumping out billions in new loans, Two Harbors has to dynamically hedge the duration risk of those incoming servicing rights. So rather than shrinking their capital markets footprint, the sheer volume of that UWM pipeline might actually force Two Harbors to become a more dominant player in the forward bond markets, just to keep the whole ship stabilized.
Okay, so the merger isn't a pivot away from financial engineering. It's actually an amplification of it.
A massive amplification.
Which makes evaluating their current financial baseline incredibly important. We really need to look at how the underlying engine is performing right now before they drop this $400 billion UWM block onto the chassis.
Absolutely.
So CFO William Dalal presented the Q4 numbers, and honestly, we have a classic case of GAAP accounting optics versus core economic reality here.
Oh, totally. The headline figures require some really aggressive unpacking.
Yeah.
Because on the surface, Q4 actually looked quite robust. Dalal reported a positive 3.9% total economic return for the quarter.
Okay.
Book value crept up from $11.04 to $11.13 per share, and they maintained a 34-cent common stock dividend?
Right. And for a single quarter operating in a complete federal data blackout, those are highly respectable metrics.
Exactly. But then you zoom out to the full calendar year of 2025, and the headline number is a negative 12.6% total economic return.
Right. And if I am a retail investor screening stocks and I see a double-digit negative return for a mortgage REIT, my immediate assumption is that their hedging strategy just completely failed.
Yeah, or they suffered massive margin calls.
Exactly. But the transcript explicitly states that this negative return is almost entirely driven by a massive, isolated legal event.
Right. The operational performance of the actual portfolio was entirely obscured by this previously recorded litigation settlement expense of $3.50 per share.
That's huge.
It is. And when you're analyzing a financial institution, you have to separate legacy legal liabilities from the current yield-generating capacity of the actual assets.
Right.
Because if you back out that $3.50 per share settlement, the core portfolio actually generated a positive 12.1% economic return for the year.
Okay, but let's talk about the cash flow implications of that.
Yeah.
Because taking a $3.50 per share hit, regardless of whether it's an operational loss or a legacy legal settlement, that drains actual liquidity from the company.
Oh, it's real cash going out the door, definitely.
Right, it pulls cash out of the war chest.
Yeah.
So if I'm evaluating their defensive posture, I need to know how thick the hull of the ship is after taking a torpedo like that.
Well, the balance sheet remains remarkably fortified, honestly.
Really?
Yeah. Even after accounting for all those legacy issues, Two Harbors ended the quarter sitting on over $800 million of cash. And in the context of a highly levered financial vehicle like a REIT, $800 million in unencumbered cash is just pure defensive optionality. It means they aren't forced sellers of any asset if the market suddenly seizes up.
And we actually saw them deploy some of that capital in a very strategic way regarding their debt profile.
Yes, we did.
The transcript highlights that Two Harbors fully repaid their $261.9 million convertible senior notes right on the maturity date of January 15, 2026.
And the mechanics of a convertible note are really essential to understand here.
Yeah, explain that.
So a convertible note gives the bondholder the option to convert that debt into shares of Two Harbors common stock at a specific strike price.
Okay.
Or they can just demand their principal back in cash at maturity. Now, if a company is financially distressed or if they just want to preserve cash at all costs, they might try to roll that debt over, issue new bonds at a much higher interest rate, or force a stock conversion that massively dilutes all the existing shareholders.
Right, which shareholders hate.
Exactly. But Two Harbors didn't play any of those games. They simply stroked a check for $261.9 million and entirely extinguished the debt.
It is the ultimate flex of balance sheet strength.
It really is.
Because it completely prevents shareholder dilution, and it instantly cleans up the liability side of the ledger.
Yeah.
And on top of that cash repayment, they noted they're maintaining $1.1 billion in unused MSR asset financing capacity.
Yeah, that $1.1 billion represents pre-negotiated available credit lines secured against their servicing rights. It is a massive liquidity buffer.
So if the repo markets, the short-term borrowing markets where these REITs fund their daily operations, if those experience a sudden freeze.
Two Harbors has $1.1 billion of committed capital they can draw down immediately.
Right. So they are entering this UWM merger with a fortress balance sheet, which honestly they absolutely need because the mechanics of how they actually generate income are under some pretty serious pressure.
Yeah, let's dissect those income mechanics because they reported $50.4 million in comprehensive income, which equates to 48 cents per share. But the components of that income are incredibly sensitive to both interest rates and seasonal behavior. The text specifically calls out a decrease in float income.
Right. And float income, that's one of the hidden engines of a mortgage servicer.
It's massive.
Because when you hold hundreds of billions of dollars in MSRs, you are responsible for collecting the homeowner's property taxes and insurance premiums every single month.
Yeah.
But you don't pay the local county tax assessor monthly. You pay them maybe once or twice a year. So for months at a time, Two Harbors is just sitting on billions of dollars in escrow accounts.
Just holding it.
Exactly. And they invest that cash in ultra-safe, short-term instruments to earn a yield. That yield is the float.
Right. And if the Federal Reserve cuts interest rates, the yield on those short-term instruments drops instantly, which directly compresses their float income.
Yeah, but the transcript also points out a seasonal factor too, right?
Yes, because escrow balances are not static. In the fourth quarter, particularly toward the end of the year, massive property tax bills come due all across the country.
Right, the tax man comes knocking.
Exactly. So the servicers have to drain those escrow accounts and wire the money to thousands of different municipalities.
Ah, I see.
When the principal balance of the escrow accounts plummets like that, the float income proportionally collapses, regardless of where interest rates even are.
So they took a hit on float income due to seasonal tax payouts and lower short-term rates.
Yeah.
And furthermore, they acknowledged a net overall decline in the yield of their broader portfolio assets. The bonds they hold are just throwing off less cash.
Right.
So if asset yields are dropping and float income is shrinking, the only mathematical way to maintain positive comprehensive income is to drastically cut the cost of your liabilities.
And that is precisely the maneuver they executed.
Okay.
Because the hallmark of a really sophisticated REIT is not just maximizing asset yield, it is ruthlessly managing the spread between the asset yield and the borrowing cost.
The net interest margin.
Exactly. As their asset yields compressed, Two Harbors successfully negotiated and restructured their financing to drive down their borrowing costs at an even faster rate.
Wow.
They defended the net interest margin by shrinking the liability side of the equation.
Which proves they can pull the operational levers really effectively internally.
Absolutely.
But no amount of internal financial engineering can completely insulate them from the external macro environment.
No, you can't escape the macro.
And in Q4 2025, that environment was dictated by aggressive, unprecedented government intervention.
Yeah, the administration pulled several unilateral policy levers that fundamentally altered the pricing mechanics of the residential mortgage market.
And we must evaluate these actions purely as mathematical inputs that Two Harbors had to navigate. We're not taking a political stance here, just looking at the market reality.
Exactly, we're just looking at the math. The administration made an overt, stated policy decision to drive mortgage rates lower.
They didn't just express a desire. They actively deployed the balance sheets of the government-sponsored enterprises to force the market.
Yeah.
The transcript notes increased GSE buying, strongly supported by explicit rhetoric from the director of the Federal Housing Finance Agency, the FHFA.
Right.
So let's look at the mechanics of this intervention. When Fannie Mae and Freddie Mac are instructed to aggressively step into the secondary market and buy mortgage-backed securities, they act as an infinite liquidity buyer.
Yeah, and it creates a massive artificial supply constraint.
Right. Standard economic theory dictates that if demand skyrockets while supply remains fixed, or even shrinks, the price of the asset surges.
And in the bond market, price and yield operate on an inverse seesaw. As the GSEs drove the price of RMBs up, the yields attached to those bonds plummeted.
Which violently compressed the spreads. Yeah. And just to clarify, a spread is the premium an investor demands for taking on the specific risk of a mortgage compared to a risk-free U.S. Treasury bond.
Right.
So if the U.S. Treasury pays 4% and a mortgage bond pays 5.5%, the spread is 150 basis points.
And the text tells us exactly how hard this government buying squeezed that premium. The nominal spread for current coupon RMBs tightened by 30 basis points, landing at an incredibly narrow 114 basis points.
A 30 basis point compression in a single quarter is a seismic event in fixed income.
It's massive. It brought mortgage spreads to their tightest level since the second quarter of 2022.
So the government essentially engineered a massive reduction in the perceived risk premium of holding mortgage debt.
Yes. But this intervention created a fascinating paradox in the derivatives market.
Yeah.
Because you would expect unprecedented government manipulation of a massive asset class to trigger wild volatility, right?
Yeah.
As private capital tries to price in all these distortions.
But you'd expect the market to be freaking out.
Exactly. Instead, it created a volatility vacuum.
Oh, right. The metric that CIO Nick Letica highlighted is almost unbelievable. The 1-month realized volatility of 10-year swap rates collapsed into the bottom 5th percentile of all recorded months over the past decade.
The market essentially just stopped moving entirely.
Yeah. 2-year options on 10-year swap rates closed at 79 basis points, dipping below the 10-year historical average.
And we have to look at how option pricing works to really understand the severity of this.
Break that down.
An option is essentially an insurance policy against future price movement. If investors expect massive swings in interest rates, the cost of that insurance the premium skyrockets.
Right.
The fact that 2-year options are trading below the 10-year average means the market, collectively, has decided that the government has effectively placed a straitjacket on interest rates.
Wow.
Traders are literally refusing to pay up for volatility protection because they don't believe the administration will even allow rates to move.
But this creates a terrifying asymmetric risk profile for an institutional investor, doesn't it?
Oh, incredibly terrifying.
Because if spreads are artificially pinned at 114 basis points because the government is buying everything, there's virtually zero upside left.
Right.
Spreads cannot mathematically tighten much further without crossing into completely irrational territory where investors are taking on mortgage risk for free.
Yeah, the upside is firmly capped.
But the downside is a cliff. If the administration suddenly reverses policy, or if inflation spikes, forcing the Fed's hand, or if foreign buyers dump treasuries, the government's grip could slip.
And if that happens, spreads could violently gap out from 114 basis points back to 160 or 180 basis points.
And when spreads widen that fast, the price of the RMBS bonds held on Two Harbors' balance sheet would plummet, resulting in massive mark-to-market losses.
It is the financial equivalent of picking up pennies in front of a steamroller.
Exactly. You are risking massive capital destruction for a tiny incremental yield.
And Letica recognized this instantly. Because the risk-reward ratio became so heavily skewed toward downside risk, Two Harbors actively chose to dial back their leverage and assume a deeply defensive posture.
They refused to chase that final fraction of yield in a manipulated market.
Right. And to execute that defense, they relied entirely on their paired portfolio construction.
Okay, yes. Let's talk about that.
This is the structural core of Two Harbors. They do not just hold bonds, and they do not just hold servicing rights. They pair them together to create an internal macroeconomic hedge.
So let's break down the mechanics of this paired construction, because it operates like this elegant set of interlocking gears. You have the RMBS on one side and the MSRs on the other.
Yeah.
And they react to interest rate movements in completely opposite ways.
Exactly. So consider a scenario where interest rates plummet. Homeowners immediately rush to refinance their loans to capture the lower monthly payment rate.
Of course.
When a mortgage is refinanced, the original loan is paid off. For the MSR side of the portfolio, this is catastrophic. The administrative right to service that loan vanishes the moment the loan is extinguished.
The value of the MSR drops to zero.
Yes. However, on the RMBS side, falling interest rates generally push the value of those fixed income bonds significantly higher. So the bond portfolio acts as a parachute for the MSR portfolio.
But the dynamic flips when rates rise.
Right.
If mortgage rates spike, nobody refinances. The homeowner with a 3% mortgage is never going to give that up for a 7% mortgage.
Never. They're locked in.
They stay in that house and they keep paying that mortgage for years. For Two Harbors, this means their MSR asset becomes incredibly durable.
Yeah.
The expected cash flow extends out for a decade or more, causing the value of the MSR to surge. Conversely, rising rates crush the value of the fixed-rate RMBS bonds.
So in that case, the MSR acts as the parachute for the bond portfolio.
It's brilliant.
It is, and the transcript reveals exactly how bulletproof their specific MSR portfolio is against the current environment.
Yeah, give us the numbers on that.
They noted that their MSRs are heavily concentrated in low-coupon loans. As primary mortgage rates drifted to 6.25% in the fourth quarter, Two Harbors analyzed their book and found that only 3% of their entire MSR portfolio was considered in the money for a refinance.
Just 3%. Let's contextualize that because that's wild. If you hold a $400,000 mortgage at 3%, your principal and interest payment is roughly $1,680 a month.
Yeah.
If you refinance that exact same $400,000 balance at the current 6.25% rate, your payment skyrockets to $2,460 a month.
Yeah, you'd be volunteering to pay an extra $780 a month, plus thousands of dollars in closing costs.
Right. So mathematically, 97% of the homeowners in Two Harbors' servicing book have absolutely zero financial incentive to refinance.
Zero.
The prepayment risk is functionally eliminated for the vast majority of their assets.
And that forces the MSR to act as an incredibly stable, high-yielding anchor. The text explicitly states that despite the massive spread tightening on the RMBS side, the low-coupon MSR continued to earn its carry.
Meaning what exactly?
It just threw off massive cash flow while shielding the balance sheet from the volatility of the bond market.
Okay, but we have to stress test their math here.
Sure.
Because while 97% of their specific book is safe, the broader market dynamics shifted in Q4.
They did.
The transcript admits that as rates drifted down to 6.25%, the share of 30-year loans in the broader U.S. market eligible for a refinance spiked to nearly 20%.
Yeah, the prepayment S-curve steepened sharply.
Right. If 1/5 of the entire market is suddenly in a position to refi, it strains credibility to think Two Harbors is entirely immune to that.
Well, it comes down to granular, loan-level asset selection. Two Harbors isn't just buying an index fund of the American mortgage market,
Right.
They are using massive data sets to cherry-pick specific pools of loans. They target geographies, credit profiles, and loan balances where the borrower is statistically less likely to refinance, even if they are marginally in the money.
And what's the proof of that?
The proof is in their prepayment metrics. The text notes that despite the broader market S-curve steepening so aggressively, Two Harbors' aggregate constant prepayment rate, the CPR, only shifted from 8.3% to 8.6%.
A 0.3% bump in prepayments when the broader market refi eligibility surges to 20%. That is an astounding level of precision.
It's incredible. It means their models are actively outperforming the macro environment.
But they are also deploying active tactical defense mechanisms to protect the sliver of the portfolio that is vulnerable, right?
Yeah, they are. The text highlights the performance of their direct-to-consumer platform, the DTC channel.
Explain how that works.
The DTC platform is a critical recapture mechanism. When one of those rare homeowners in their 3% in-the-money bucket actually decides to refinance, Two Harbors doesn't want to just passively lose the MSR.
Right, they want to keep the asset.
Exactly. So they use data triggers like a credit pull for a mortgage inquiry to identify that the homeowner is shopping around. The DTC platform immediately contacts that borrower and offers to originate the new loan directly.
Oh, that's smart. They act as the originator to replace the exact asset they are about to lose.
Yep, and the transcript says the DTC channel was punching above its weight, funding a record $94 million in first and second liens.
Now, $94 million is a rounding error on a $400 billion portfolio. But the dollar amount isn't really the point, is it?
Not at all. It is a proof of concept. They have built the internal machinery to capture runoff. It transforms a defensive weakness prepayment risk into a brand new origination revenue stream.
Okay, alongside the DTC recapture, they executed a highly aggressive unilateral cut to one of their most toxic risk exposures.
Oh yeah, this is a big one.
The transcript reveals they reduced their inverse IO position by almost 50% to systematically cut exposure to higher coupons.
Yeah, and the inverse IO is where the financial engineering gets highly complex and honestly highly dangerous.
Break it down for us. What's an IO?
An IO is an interest-only strip. If a pool of mortgages generates $1 million in principal payments and $500,000 in interest payments every month, the bond is essentially sliced in half.
Okay. One investor buys the right to receive only the principal, and another buys the IO strip, receiving only the interest.
Simple enough. But an inverse IO.
An inverse IO adds a derivative layer on top of that.
Yeah.
The coupon rate paid to the investor is tied to a floating benchmark index, like SOFR, but it moves in the exact opposite direction.
So the formula is typically a fixed rate minus the floating rate.
Exactly. If the Federal Reserve cuts rates and SOFR drops, the mathematical yield on the inverse IO actually explodes higher.
Which sounds like an incredible asset to hold in a rate-cutting environment.
It does, but the structural flaw is catastrophic.
What's the flaw?
The flaw is the underlying principle. You only get paid that massive interest yield as long as the underlying mortgages actually exist.
Oh.
Because Two Harbors held inverse IOs tied to higher coupon mortgages loans with rates like 6 or 7%. Those underlying borrowers were the exact people rushing to refinance as rates drifted down to 6.25%.
Right. And the moment they refinance, the principal vanishes, the interest payments immediately cease, and the high-yielding inverse IO becomes completely worthless overnight.
The asset just vaporizes.
Literally goes to zero. It is a hyper-leveraged bet on borrower inertia.
Wow. And recognizing that the administration was actively trying to force rates lower to trigger those exact refinances, Two Harbors didn't wait to see if their models would hold.
No, they didn't.
They violently chopped their inverse IO position in half.
Yeah.
They sacrificed the high potential yield to eliminate the existential risk of a massive capital wipeout.
It is the absolute definition of defensive portfolio management.
Yeah.
You combine the paired MSR and RMBS structure, the surgical asset selection keeping CPR at 8.6%, the DTC recapture platform, and the ruthless elimination of toxic inverse IO exposure.
And you get a portfolio engineered to survive the government-induced volatility vacuum. Which brings us to the ultimate bottom line for the investor. After executing all of these defensive maneuvers, paying off the convertible debt, and navigating the 30 basis point spread compression, what does this machine actually produce?
Well, management provided a prospective quarterly static return projection per share of 16 to 31 cents.
Okay. And if you annualize that projection, it yields a 5.8% to 11.1% potential return on common equity.
Right. And in an environment defined by historically low volatility, zero reliable macroeconomic data, and overwhelming government market manipulation.
Constructing a portfolio that mathematically projects a steady 6 to 11% return without requiring massive leverage is a masterclass in risk-adjusted capital allocation.
It truly is.
And this leads us perfectly into the analyst Q&A portion of the call. Because when you have a management team executing this level of complex defense while simultaneously attempting a $400 billion merger, Wall Street analysts are going to probe every single weld on the hull.
Oh, they came with questions. The Q&A session was heavily themed around two major anxieties: strategic drift and the illusion of the macro environment.
Let's look at the first theme. Analysts were deeply concerned that the UWM merger was distracting the trading desk. Rick Shane from JP Morgan and Doug Carter from UBS both attacked this angle.
Yeah, Rick Shane asked a very direct question about tactical capital allocation. He wanted to know if the sheer operational weight of integrating UWM's pipeline was forcing two harbors to abandon their day-to-day tactical trading.
Like, are they so focused on the strategic horizon that they are ignoring current market dislocations?
Exactly. And management forcefully rejected the premise. They stated they're operating purely in the ordinary course, meaning their daily portfolio construction and risk-reward assessments remain entirely walled off from the merger timeline.
But Rick Shane, recognizing he had the first slot in the queue, pushed the issue by demanding a real-time update on the book value to prove it.
Which is a highly aggressive tactic, demanding mid-quarter, intra-month financials on an earnings call covering the previous quarter.
It's super aggressive.
But Nick Letica took the bait and delivered a massive confidence boost. He revealed that as of January 30th, a full month into the new quarter, the book value was already up 1.5 to 2%.
That intra-quarter data point completely neutralizes the argument that the trading desk is distracted.
Completely.
It proves the defensive maneuvers, the inverse IO cuts, the paired hedging, they are actively generating positive returns right now.
But then Doug Carter followed up by attacking the leverage side of the strategy. If book value is up and spreads are tight, he wanted to know if Two Harbors was tempted to add leverage to buy more assets and juice the returns.
Right. And Letica's response to Doug Carter provides the clearest window into how institutional money views government intervention.
Yeah, Letica explained they are refusing to add leverage precisely because the administration holds unilateral trump cards.
What specifically?
He specifically pointed to the administration's ability to arbitrarily raise the GSE portfolio caps.
Okay, the portfolio cap. That is a strict legal limit on exactly how many billions of dollars in mortgages Fannie Mae and Freddie Mac are allowed to hold on their own balance sheets.
Right.
So if the administration wants to drive rates even lower without going through Congress, they can simply order the FHFA to raise those caps.
And the GSEs would instantly flood the market with hundreds of billions of dollars in new buying power, further crushing private capital and violently warping spreads.
Right. So Letica essentially told Wall Street, we are not going to borrow billions of dollars to buy bonds at artificially high prices when the largest, most irrational actor in the entire market can change the fundamental rules of supply and demand overnight with a stroke of a pen.
Prudent managers do not lever up into a politically manipulated market. They lower their leverage, hoard cash, and wait for the artificial constraints to break.
Man. And this anxiety over government intervention bled directly into a highly technical question from Bose George at KBW.
Yes.
He wanted to know about the pricing mechanics of the LLPA grid.
Yeah, and for anyone outside the mortgage underwriting space, the LLPA, the loan level price adjustment, is the matrix of fees that Fannie and Freddie charge to guarantee a loan.
Right. If you have a 680 credit score and put 5% down, you pay a much higher LLPA fee than someone with an 800 credit score putting 20% down.
Exactly. And these fees directly impact the final interest rate the consumer pays. Bose George was probing a specific rumor. What if the administration desperate to stimulate housing, unilaterally slashes the LLPA fees across the board.
If it suddenly becomes vastly cheaper to get a government guarantee, millions of borrowers who were previously priced out might suddenly qualify for a refinance.
It would be a shockwave to the prepayment speeds. It would trigger the exact refi wave Two Harbors has been defending against.
Right. So George wanted to know if the market had already priced this catastrophic optionality into the current bond valuations.
And management offered a pretty sobering assessment. They noted that the market has partially priced it in, but because the administration is operating in a data blackout and utilizing multiple overlapping levers, GSE caps, explicit buying, and potential LLPA cuts, it is mathematically impossible for the market to perfectly price the exact magnitude of the intervention before it happens.
Or risk remains a live wire.
Yes.
Which brought Trevor Cranston to the microphone to ask the ultimate retail investor question. If spreads are compressing and the government is artificially suppressing asset yields, how does Two Harbors maintain the dividend?
Yeah, Cranston was attacking the mathematical reality of a 5 basis point tightening across the broader portfolio in January. When your asset yields drop, your net interest margin shrinks.
Right.
Management was forced to admit that this continuous spread tightening marginally lowers the future return potential of the portfolio. They defended the current dividend, but cautioned that it was too early in the quarter to declare a definitive long-term trend.
It was a subtle acknowledgement that you cannot sustain a high-yield dividend indefinitely if the government refuses to let the underlying assets generate a natural market yield.
Exactly.
This overarching tension, the artificial suppression of the market, culminated in a profound macro question from Harsh Nanny.
Oh, this is a great question.
He pointed out the massive contradiction staring the market in the face. You have a new Federal Reserve Chair nominee entering the picture, and inflation is visibly running hotter than the Fed's target, yet volatility is sitting in the bottom 5th percentile.
Yeah, Hirsch was highlighting the illusion. You cannot have sticky, hot inflation and a transitioning central bank combined with zero market volatility. Something has to snap.
And Nick Letica agreed entirely. He laid out the expectation that the sheer friction of a new Fed chair trying to build consensus while battling entrenched inflation will inevitably shatter the volatility vacuum.
He expects a return to historically normal, higher levels of volatility.
And ironically, an explosion of volatility is exactly what Two Harbors wants, isn't it?
Oh, definitely. They have $800 million in cash, a pristine balance sheet, and a defensively paired portfolio.
If the market violently corrects and spreads gap out, the forced sellers will panic, and Two Harbors will step in with their massive liquidity to buy assets at deeply discounted prices.
Yeah. They are ready to pounce.
Then the final analyst, Eric Hagan, brought the conversation full circle back to the core MSR asset.
He questioned the supply dynamics. If mortgage origination volumes remain suppressed due to higher overall rates, won't the supply of newly created MSRs dry up, starving Two Harbors of new assets just as they double their capacity?
Right. Reasonable question. Management countered by focusing on the demand side of the equation.
Yeah.
Even if the overall volume of new MSRs drops, the institutional demand for these assets remains ferocious. Because an MSR acts as that perfect negative duration hedge against bond portfolios, major banks and REITs are desperate to hold them.
And this insulates the value of Two Harbors' existing $400 billion book. Even if they don't add a single new loan, the scarcity of the asset will protect its valuation on the balance sheet.
Analyzing a transcript of this density requires you to step back and look at the absolute absurdity of the financial machinery at work here.
It really does.
We have spent this deep dive dissecting how a publicly traded entity uses derivative structures, forward TBA contracts, and massive credit facilities to defend a $400 billion portfolio against a government that has turned off the economic data dashboard while simultaneously manipulating bond yields.
It is financial multitasking at a level that borders on science fiction.
It really is.
But the foundational asset beneath all of these derivatives, all of the inverse IOs, and the entire UWM pipeline is startlingly mundane. Two Harbors is building a multi-billion-dollar empire by using supercomputers and Wall Street capital to anticipate the behavior of millions of individual Americans.
That is the ultimate paradox of mortgage finance. If the macroeconomic policies we discuss successfully force mortgage rates down, it alters the complex hedging math for institutional giants like Two Harbors.
Right, but fundamentally, it profoundly alters the net worth, the monthly cash flow, and the physical mobility of the working class.
So the question for you to consider as you digest all of these mechanical realities is this. When we talk about macroeconomic volatility on Wall Street, when spreads widen, when inverse IOs collapse, when billions of dollars change hands in the TBA market, how much of that is just a mathematical echo?
Is the real volatility actually just the byproduct of a million individual homeowners collectively sitting at their kitchen tables doing the math on a legal pad and deciding whether or not they can finally afford to click refinance on a Tuesday afternoon?
Wall Street builds the models and constructs the derivatives, but it is Main Street that ultimately pulls the trigger. Thank you for joining us on this deep dive. Keep examining the mechanics behind the headlines and keep asking the big questions.